Hello, all my dear students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So, after the RTP and the past papers, we are going to now start with the MTPs. I know that there are few past papers which I am about to put, which I will put separately. Don't worry. Now, today we are going to talk about 8 MTPs, including the mock test paper of May 2026. So, we are going to total talk about 8 MTPs in today's paper. Now, few things I would like to say before we start with the session, and that is because you have already done 9 RTPs and 9 past papers. Now, believe me, many questions in the MTP, around 70% of the questions in MTP is going to repeat. 70%. Because the MTP is the most hopeless paper that the ICI can remove for the practice of for the practice of students. Yes, RTPs are very good. Past papers are obviously good. But MTPs are very hopeless. Don't expect that the questions like MTP will come in the examination. MTPs are very, very simple in general. Yes, one or two questions in every MTP are very, very, very good. But otherwise, most of the MTPs are very, very, very straightforward. So, what I'm going to do over here is, I will cover 8 MTPs with you all in full English. But if any question is exactly similar, then I will not do that question. I will give you a reference also where we have done that question in the RTP or past paper or even in MTP. Yes, even if one or two adjustments are different or something which is new, that I will discuss. But if something which is exactly same, exactly no change in sentence, full stop, comma, nothing is changed, then doesn't make sense to do that particular question once again. It will waste your time first and then my time also. Our objective is to cover maximum content in minimum time. Optimum utilization of time we have to do. Our objective is not to repeat same questions again and again, especially when they are exactly same. Okay. So these are the few things that I had to say before I can start with the discussion. We are starting with MTP Series 1 May 2025. The very first question over here is on total income. We are supposed to compute total income and tax liability as per the normal provision. Not as per 115BAA, not as per 115BAB. Ignore MAT. The turnover of last year is 390 crore. Therefore, the tax rate will be 25%. Okay. Now let's start with the question. The associate is a company. It is a manufacturer. The net profit is 350 lakhs. The very first thing, they have paid 1 lakh rupees to independent directors for attending board meeting, but they have not deducted TDS under 194J. They should have deducted. See, any payment made to director over and above salary is subject to TDS under 194J at the rate of 10% without threshold. Even threshold is not required for payment made to directors. See, payment made to directors can come under two sections. If a salary is paid to director, it will go under 192. But if other than salary, like board meeting, etc., fees is paid to independent directors, etc., then in that case, 194J TDS is applicable. No threshold is there. Generally, the threshold of 50,000 is there in 194J. But for director, there is no threshold. You have to deduct TDS. You have not deducted TDS, 30% expenditure will be disallowed. Next one, opening stock and closing stocks are overvalued. Okay. How much is opening stock? 200 lakhs. It is overvalued by how much percent? 10%. Therefore, it is 110 lakhs. Therefore, 10 is how much? Cross multiply. Whatever amount will come, that is overvalued. If opening stock is overvalued, means debit side of P&L is overvalued. It means you have claimed more expense. Therefore, add back. Similarly, if closing stock is overvalued, then reduce because you have increased the credit side. Therefore, the profit is increased. So, reduce. As simple as that. Next, depreciation as per the books of accounts, you will add back. Contribution to national laboratory allowed as deduction under the new regime, under the old regime. Under new regime, 35(2)AA is not allowed, but under old regime it is allowed. We are following as per the old regime, as per the normal regime. Then you have paid some GST of this year on 27 December. This is late. GST should have been paid on or before the due date of filing of return. Therefore, because it is paid after the due date of filing of return, therefore it will be disallowed under 43B. You have purchased some goods of 63 lakh rupees from a company in which your directors have substantial interest. Therefore, you are related party. So, from related party, you are purchasing goods for 63 lakhs. The market value of the goods is 58 lakh. Therefore, 5 lakh excess payment you are doing, that will be disallowed under 48(2). Excess payment made to related party, disallowed. Next, you are making some cash payment. To whom? To road transporter. Lorry, truck. So can you make it a cash payment to a road transporter? Yes, up to 35,000 you can make. Generally, you cannot make cash payment of more than 10,000, but to lorry, truck transporter, you can make up to 35,000. Therefore, here, first payment you have made 40,000 disallowed. This will be disallowed. 35,000 will be allowed. If it exceeds 35,000, then it is disallowed. So 35,000 will be allowed. 52,000 will be disallowed. Not allowed. Next, you are incurring some legal expenses for bonus shares. So if you incur some legal expenses for bonus shares, I have already told you it is allowed because issuing of bonus share does not increase the permanent capital of the company. Therefore, it's a revenue expense. But if you incur some legal expenses for right shares, then it is disallowed. That is not allowed. Because right shares lead to what? Permanent increase in the capital of the business. Therefore, it will not be allowed. Next is donation to political party paid by check. Disallow in PGBP and claim under 80 GGB later on. Because the payment is made by check, you can claim the deduction. If the payment is made by cash, you cannot claim. Next is depreciation 62 lakhs you can claim as per income tax law. You can reduce it from your P&L. And last but not least, you have claimed a bad debts of 4 lakh rupees, out of which you have recovered 2 lakh rupees. So that is deemed income under section 41 subsection for recovery of bad debts, but you have not given the effect in the books of accounts. So add back to PGBP. So add back this to PGBP. I hope it is clear to all of you. After that, it's very simple question, nothing great as such. Just compute tax, 25% tax. If applicable, apply surcharge also, and 4% cess. That's it. It's a very, very simple question. Question number 2. There is an LLP over here, which is engaged in export. Therefore, it has a SEZ unit, unit 1, and unit 2 is a domestic tariff area unit. So SEZ unit was set up 6th year back. Therefore, this is the 6th year of operation. Therefore, the assessee will be eligible for deduction of how much? 50%. After 5 years, you were eligible for 50% deduction. Now, we are supposed to compute total income tax liability of beta LLP. So, if we are supposed to compute, so a lot of things we are supposed to compute. We are supposed to compute gross total income. Then from gross total income, we will compute 10AA deduction. After that, we will compute total income, then tax, then we will also compute AMT. We have to compute AMT now because LLP and they are claiming 10AA. So, what is the profit of the assessee? Let's see. Net profit is 71 lakh for unit 1, SEZ unit, and unit 2, 840 lakhs. Add both of them. And now, in that, unit 1, 41 lakh will be disallowed. So, add 41 lakh to this. And in unit 2, 48.3, 55 lakhs will be disallowed. So, add 55 lakhs to 840 lakhs. Therefore, your total profit will be 751. How 751? 710 plus 41. And this unit 2 profit will be 895. How 895? 840 plus 55. So this will come to 895. Total profit is 1646. Now we will compute 10AA deduction. How we will get 10AA deduction? Profit from the export unit multiplied by export turnover of unit 1 divided by total turnover of unit 1. We will try to compute one by one all three parameters. Let's talk about the export turnover of unit 1 first. Sir, what is the export turnover of the unit 1? The export turnover of the unit 1 is as follows. Pay attention please all of you. The export sales is 1800 lakhs, but out of that only 1600 lakhs is received. Only what? The export turnover is 1800 lakhs, out of which 1600 lakhs is received in India. So you can take only that much export turnover which is received in India within 6 months in convertible foreign currency. So you cannot take, you can only take 1600 rupees in the export turnover. In that also, in 1600 also, there are some expenses like insurance and freight. In export turnover, you cannot take insurance, freight and other communication, other telecommunication charges and other charges. The export turnover has to be FOB price, free on board price. It cannot be COB. Therefore, your export turnover first of all will only include realized amount, that is 1600. From that also reduce expenses. So expenses are 180. Therefore, export turnover is ultimately 1420. Okay. Now what is total turnover? Total turnover is a what? 1800 is my export turnover and domestic turnover is 300. So total turnover is 2100. Now in total turnover, you do not care about how much is received, how much is not received. Everything is part of total turnover. But yes, in total turnover, again you cannot take what? Certain expenses. Which expenses? You cannot take certain expenses like insurance and freight. So how much is insurance and freight in total turnover? In total turnover, the insurance and freight is 300 lakh. So therefore from 2100 I will reduce 300, that will come to 1800. So I got my export turnover also, I got my total turnover also. Now I will compute my profit. How much is the profit from unit 1? Profit from SEZ unit is 751, 710 plus 41. But in this 751 I cannot take two things. That is, I cannot take duty drawback, I cannot take profit on sale of license. Remember, export profit from the export does not include duty drawback, profit on sale of import license, and cash assistance. Yes, all these things are not part of what? Profit from export. Therefore, I have to reduce all these things. If I reduce all these things, I will get 666 as my profit. Now, I will multiply 666 into 1420 export turnover divided by 1800 total turnover, and therefore, I will get my deduction. Of that, I will take 50% deduction. Therefore, my deduction comes to how much? 262.570. After that, I will compute tax. That's it. On that, 1383, I will apply 30% tax, 12% surcharge because the income is more than 1 crore, 4% cess. This is my tax as per normal provision. Now I will compute tax as per AMT. For AMT, I have to compute adjusted total income. How will I compute adjusted total income? Total income 1383 plus 262 is my adjusted total income. On that, I will apply 18.5% tax. That is 18.5% AMT, 12% surcharge, 4% cess, and then I will compare whichever is higher and try to find out the AMT credit. I hope it is clear to all of you. So this is what this question is all about. Let's go ahead with the third question. The third question is also a very good question. Fashion Inc. is a notified foreign institutional investor. Always remember, whenever in the question FII will come, FII, there is only one section which is possible, that is 115 AD. Now we need to compute the total income and the tax liability of this particular FII, assuming they do not have any other income. Okay, now let's compute the total income. First of all, dividend from the listed shares of Indian company, dividend for FII as per 115 AD is taxable at 20% plus surcharge if applicable and cess. Okay. Next, interest on security for FII is again taxable at 20%, but you will not get the deduction of these expenses. Gross dividend, gross interest is taxable. Expense will not be allowed as deduction. Third one. Bonds you have purchased in 2019 and in 2026 you have sold. So you have purchased for 43 lakhs. You have sold for 58 lakhs. So there is a profit of how much? There is a gain of 15 lakh rupees. This is long-term capital gains. Is this covered under 112A? No. This is normal long-term capital gain. Therefore, normal long-term capital gain is taxable at 12.5% under 115AD. Next one, listed shares on which STT is paid. It is written below. Listed shares on which STT is paid. It is purchased on 2nd May and sold on 9th February. Sold within 12 months. Therefore, it is short-term capital gains and it is listed share. Therefore, it will be taxable at 20% as per 111A. Next, unlisted share. It is purchased in July and sold in March 26. Again, it is short-term capital gains. Now, on this 111A is not applicable. Remember, on normal STCG in 115AD, there is a 30% tax. 30% tax will be applied. Go and check 115AD. 115AD has 4 tax rates. Long-term capital gains, normal, 12.5%. Long-term capital gains, 112A, 12.5% with an exemption of 1.25 lakhs. STCG, 111A, 20%. STCG, normal, 30%. So this will be taxed at 30%. I hope it is clear to all of you. Let's go ahead with the next question. Next question is on TDS. Mr. Anuj is buying some property. First, he is buying a property in Chennai. He is buying 3 properties. First, he is buying a property in Chennai for 85 lakhs. So TDS will be deducted or not? Yes. 1% of 85 lakhs will be deducted as TDS. Stamp duty value is not given. If stamp duty value would have been given, I would have compared with stamp duty value, and whichever is higher on that amount, I would have deducted TDS. In this question, stamp duty value is not given. Now he has purchased again another urban plot of 49 lakhs. But the stamp duty value of the urban plot is 54 lakhs. So whichever is higher. So on whichever is higher is what? Whichever is higher is 54 lakhs. So on this, he will deduct TDS 54 lakhs into 1% under 194 IEA. So if either the consideration or the stamp duty value, if both are less than 50 lakhs, then no TDS. If one of them is more than 50 lakhs or equal to 50 lakhs, then TDS is applicable. Here, the consideration is 49 lakhs, but the stamp duty value is 54 lakhs. Therefore, deduct TDS at the rate of 1% on 54 lakhs. Next one, he is purchasing some rural agriculture land. On rural agriculture land, TDS under 194 IEA is not applicable. It is exempted. Okay. Next one, there is an infrastructure debt fund in India who has taken some loan from a non-resident. So infrastructure debt fund has taken a loan from a foreign company, and in return they are paying an interest of 6 lakh rupees. How much TDS? 194 LB, 5% TDS plus 4% cess. It is 5.2%, not 5.4%. 5.2% TDS will be applicable. 194 LB. Interest deduction will not be allowed. So if the borrower is in infrastructure debt fund and the lender is non-resident or foreign company, then the borrower, when the infrastructure debt fund will pay the interest, at that time they will deduct TDS at the rate of 5.2%. Cess will not be applicable because the interest is only 6 lakh. Expense is not allowed as deduction. Will your answer change? If that foreign company is located in NJ. If that foreign company is located in NJ, then 5% is not applicable. Then 30% plus 4% cess, 31.2% tax will be deducted in that case. I hope it is clear to all of you. Next one. An airline company is paying landing and parking charges to the Airport Authority of India. So So the landing and parking charges paid to the Airport Authority of India will be subject to deduction of TDS under 194C and not under 194I as held by Supreme Court in the case of Japan Airlines. Next one, an employee of government is receiving arrears of salary. So he is asking a question whether entire arrears of salary will be subject to tax deduction. The answer is no. If the employee gives Form 10E, Form 10E, E for elephant, then in that case the employer will give relief under section 89 for arrears of salary, and after that he will deduct the TDS. If the employee does not give Form 10E, then he will deduct TDS on the entire amount. I hope it is clear to all of you. Let's move on to the next question. Next question, question number 5, part 1. An income tax authority has lost a case against an assessee at CIT appeal. So at CIT appeal, the income tax department lost a case. The name of the assessee is Bela, and the income tax department did not appeal to ITAT because the tax effect was less than the monetary limit. Can they do so? Yes, they can do so. So Bela, in front of Bela, the income tax department lost the case. So the income tax department did not file the case. Did not file the case to ITAT because the tax effect was less than 60 lakh rupees. Because for ITAT, the limit is 60 lakhs under 268A. Now the question is, similar issue arise in case of Shweta and her sister Shefali. Can they give an example of Bela and say, in case of Bela, you have not appealed. Why are you appealing in my case? No, you cannot say. This section is assessee specific. This section is year specific. Even Bela cannot say next year. This is very specific to Bela only for this year. Now Shweta and her sister cannot give a binding precedent of Bela and say that in case of Bela you have not appealed. Why are you appealing in my case? 268A is specific to assessee. 268A is specific to year. I hope it is clear to all of you. Next one, an assessee who is a partnership firm did not file the return on time. So if you don't file the return on time, there can be a prosecution launched against you. That's what the officer has done. He has filed a complaint for prosecution under 276CC. Now there is some condition for filing prosecution. In case of other than company, a prosecution can be filed only if the tax payable after reducing the advance tax is more than 10,000 rupees. So initially the tax payable is more than 10,000, it is 70,000 rupees, but then assessee appealed to CIT appeal and CIT appeal reduced the tax to how much? 9,100. So now can the prosecution be launched? The answer is no. Because for prosecution there are some conditions. First of all, there should be a willful failure of filing of return. Second, if the assessee is other than company, then the prosecution is possible only if the tax payable after reducing advance tax is more than 10,000 rupees. Now after the appeal, the tax payable has been reduced below 10,000. Because it is reduced below 10,000, therefore prosecution cannot be launched. I hope it is clear to all of you. Next question, exactly copy paste of what we have done earlier in RTP May 2024. Question number 3, you can go and check. I have given reference of everything. I am not just talking just for the sake of talking. I have given a reference of each and everything what is repeated. Next question, this question repeated. I have given the reference file already shared on Telegram channel. You can go and download from there. Okay. This question also repeated. Go and check. Next question is a slightly new question. Again, very simple question. Nothing great. One more time it is going to repeat in the next paper also in MTP. There is a foreign hockey player who is a non-resident. So there is a non-resident foreign citizen. They are coming to India for the purpose of playing in hockey and they are earning 10,000 rupees. They are earning 45 lakh rupees from hockey. So that will be subject to 20.8% tax under 194E. It is taxable under 115BBA. If a non-resident who is not a citizen of India who comes to India and participates in any game or sport is liable to tax at 20% plus 4% cess. Further, if he is writing some article in a magazine, then that is also subject to 20% tax. If he does advertisement, that is also subject to 20% tax. Yes, if he earns some lottery, then that is subject to 30% tax under 194B. So the first two incomes will be subject to 20% tax under 194E and the third income will be subject to 30% tax under 194B. But the third income you have to gross up because this is net of TDS. So what are the questions? Question number 1. Examine whether the above incomes are subject to deduction of tax at source. Yes, the first income and the second income is subject to deduction of tax under 194E at 20.8% and the third income, that is the lottery income, is subject to deduction of tax under 194B at the rate of 30% plus cess. Whether it is necessary to file the return? Yes. If they would have only earned first two incomes and TDS would have been deducted, there is no need to file the return. Now because the player is also, the foreign national player is also earning horse race or lottery income, whatever it is, therefore he is liable to file the income tax return. If you would have only earned 194E income and TDS would have been deducted, there is no need to file the income tax return. But in this case, yes, he has to file because he is earning lottery also. Next, a non-resident has made an application to authority for advance ruling on 15th of June. Now they want to withdraw the application on 21st of July. Can they do so? No. By default, you cannot. Because once you make an application, you have to make a withdrawal application. You can withdraw the application of board for advance ruling within 30 days from the date of application. Now the 30 days have expired. But there are some rulings which says that if circumstances so justify, it can allow beyond 30 days also. So by default, the law does not say beyond 30 days, but there are some rulings and some court judgments which says that if the circumstances so justify, you can withdraw beyond 30 days also. I hope it is clear to all of you. You have to write this sentence in the examination. However, if the circumstances so justify, it can be withdrawn beyond 30 days also. I hope it is clear to all of you. So this is what this paper is all about. Let's go ahead with the MTP series 2, May 2025. The very first question is on amalgamation, carry forward of losses, carry forward of UAD and other aspects. There are two companies, ABC Limited is amalgamating company and XYZ Limited is amalgamated company. Both of them are getting amalgamated on 1st April 2025. Now the profit of XYZ, that is the amalgamated company, is 140 lakhs. Now they have done one mistake. What mistake? When they took the assets from ABC Limited, that is from amalgamating company, they depreciated the asset at market value. No, you cannot depreciate the asset at market value. If an amalgamated company take assets from amalgamating company, the cost in the hands of amalgamated company is WDV in the hands of amalgamating company. So the WDV in the hands of amalgamating company is 100 lakhs. But unfortunately, you have depreciated at 150 lakhs. So you have claimed depreciation on 50 lakh rupees extra. So 50 lakh rupees depreciation you have to add back in your profit. So you have claimed depreciation on 150 lakhs, which is wrong. You should have claimed on 100 lakhs. So the profit of your company is 140 lakhs. So 50 lakh depreciation you have to add back. So 50 lakhs into 15% add back first. And then you claim the losses whichever losses are allowed. Speculative losses not allowed. Unabsorbed depreciation allowed to carry forward by ABC Limited, by XYZ Limited. Unabsorbed scientific capital nature allowed to carry forward. Unabsorbed expenditure of capital nature on scientific research allowed to carry forward by what? The amalgamated company. Business loss, yes. Normal business loss allowed, speculative business loss not allowed. Normal business loss can be carried forward by the amalgamated company for balanced number of years from 1st April 2025. Earlier it was another 8 years, but now it is balanced number of years. So because the loss is just 4 years old, the amalgamated company can carry forward for another 4 years. So you can set off this 120 lakhs also. I hope it is clear to all of you. Is it clear? So what is the ultimate answer? 140 lakhs is your profit. Then add depreciation on 50 lakh rupees because that is excess claim and reduce the 3 items. These 3 items reduce, do not reduce speculative loss. You will get your profit. I hope it is clear to all of you. Next question is a very simple question on DTW. You can go through it. We have done much better questions on DTW. We have done similar question earlier multiple times. So I am not wasting time on this. I am going to the next paper. Next question, not paper, sorry. Question number 2. Question number 2A1, very simple question. There is an institution which is running educational institution as well as hospital. The gross receipts of both of them is 4.5 crore each. Whether they are liable to take approval? Yes, they cannot get exemption like this only. Because the aggregate receipt from both hospital and from education is exceeding 5 crores. You have to check aggregate receipt from both of them should not exceed 5 crore. If it is up to 5 crore, there is no need to take approval. If it crosses 5 crore, you have to take approval. Without approval, you cannot claim exemption. I hope it is clear to all of you. Second question, we need to compute the total income of the trust. A trust is earning the following income. First, a trust is earning 14 lakhs rupees from the property held. You will add this to income. Then trust is earning 6 lakhs from business which is incidental to main object. So if the business is incidental to your main object of trust, you can add that also to the income and claim 15% exemption. Then 9 lakh you are receiving voluntary contribution, means normal donation, not corpus donation. You can add this also. Add all three of them. This is the part of your income to claim 15% exemption. Now from that, you have applied 12.8 lakh rupees towards charitable purpose. This is your application, but you need to be careful. This includes 4.8 lakhs repayment of loan for construction of orphanage. Now this entire expenditure of construction of orphanage was claimed as an application in previous year 2021. So now you cannot claim this 4.8 lakh as deduction in the current year because in 2021 you have already claimed that as an expenditure. For example, in 2021 you have taken a loan of 4.5 lakh, 4.8 lakhs for example. Listen carefully. In 2021, very important point. In 2021 you would have taken loan of, year is also important. Pay attention on the year also. In financial year 2021 you would have taken loan of 4.8 lakhs. After taking that loan, you would have incurred an expenditure on construction of orphanage. At that time, you have claimed deduction of construction of orphanage directly. Now in 25-26, if you are repaying that loan of 4.8 crore, you cannot get that deduction because that will lead to dual benefit, because already you have claimed that as an expense in 2021 while constructing the orphanage. So now while repayment, you cannot again claim. Therefore, you have to take deduction of 12.8 minus 4.8. You can claim 8 lakhs as application. You cannot claim 12.8 lakhs as application. But now you will raise question. Sir, you have explained us in class, sir. If you take a loan and incur an expenditure, then it is allowed only when the loan is repaid and not when the expenditure is incurred. That is correct. I agree. But that amendment came in Finance Act 2021. If you do that after 2021, then that is the scenario. If you have already taken a loan before 21, in this case, you have taken loan in 2021, before 2021. Correct? You have taken before 1/4/2021. Now, in this case, you have taken loan in 2021, before 1/4/2021. So that time the expenditure was directly allowed. You do not have to repay the loan. That repayment of loan condition came after 1/4/2021. That is the reason I have mentioned in our concept book also very clearly that this amendment of loan repayment has come in Finance Act 2021. So very simple. If you have taken a loan after 21, then it is allowed on repayment of loan. But if you have taken the loan before 21 and incurred the expenditure before 21, then when you repay the loan now, you cannot claim deduction of loan once again. I hope it is clear to all of you. So this is what this question is all about. Let's go ahead with the next question, which is on TDS 3A1. Bank is crediting 65 lakhs 50,000 in a separate account for macro monitoring purpose. Sir, what do you mean by this macro monitoring purpose? See, whenever you invest in bank, in fixed deposits and recurring deposits, the bank computes interest on a daily basis, but bank does not credit interest on a daily basis. They compute on a daily basis, but they don't credit on a daily basis. Computation is done on a daily basis. Every day they compute. So they compute and credit to a separate account, compute credit to a separate account, compute credit to a separate account for every customer. But at the year end or at the half year end or at the quarter end, they credit that to customer account. So the TDS is not deducted when it is computed for macro monitoring purpose. The TDS is deducted when it is actually credited to the customer's account. So here the TDS will not be applicable. Therefore, the assessing officer is not justified in disallowing the expense. Okay. Next, you are giving some profit commission by a reinsurance company to the insurance. Whether TDS is applicable? No. In 194D, it is very clearly written. 194D covers insurance commission, but it is very clearly written insurance commission will not include reinsurance. Therefore, on reinsurance, TDS will not be applicable. If it is a normal commission, then it is applicable. If an insurance company is paying to an agent, then TDS will be applicable under 194D. But if an insurance company is paying to another insurance company for reinsurance, then TDS is not applicable. I hope it is clear to all of you. Next one, we have just done that if you make some payment to director over and above salary, then you have to deduct TDS under 194J at the rate of 10%. I hope it is clear. And threshold is also not applicable. Do you remember in the previous MTP we have done? And last but not least, over here, the board for advance ruling has the power of issuing commission. Yes, board for advance ruling has 4 powers, which are similar to the powers covered under 131, which is given to the income tax authority under summon. Section 131 talks about the power to issue summon, and once the power to issue summon is given, this power can be given to the income tax authority, this power can be given to board for advance ruling, and this power can also be given to black money authority. And in this power, there are 4 powers which are given to the respective authority. First, power to discover an inspection. Second, power to enforce attendance. Third, power to compel production of books of accounts. And fourth, power to issue commissions. These are the 4 powers which are given to the income tax authority under section 131, which are given to the board for advance ruling also. I hope it is clear to all of you. Next question. Question number 4A, very simple question. There is an assessee who is having a business and the turnover of the business is 70 lakh. Is he liable to file the income tax return? Obviously, yes. Any person whose business turnover is more than 60 lakh rupees, then he is supposed to file the income tax return. What about exact 60 lakh? Exact 60 lakh, no need to file the return. If your business turnover is more than 60 lakh, file the return. So he has to file the return. Similarly, Mr. Vicky received a gift from his son, 50 lakh rupees. After that, he deposited that entire sum in his saving account. Is he liable to file the return? The answer is yes. If you deposit 50 lakh or more in a saving bank account, you are liable to file the income tax return. Remember, for that business limit, it is more than 60 lakh. But for saving bank limit, it is greater than equal to 50 lakhs. Exact 50 lakh if you deposit, then also it is liable for what? Filing the return. I hope it is clear to all of you. Next one. Can tribunal, while listening to the rectification application, reappreciate the entire evidence? No. First of all, does the tribunal has the power to rectify an apparent mistake? The answer is yes. Tribunal will not rectify its mistake under 154. For tribunal, the power is given under section 254 subsection 2 separately. Yes, tribunal can rectify an apparent mistake, but while rectifying the apparent mistake, they cannot reappreciate the entire matter once again. I have told you in the class many times, tribunal cannot review its own order. Tribunal cannot take a second view without any valid reason. They can only rectify an apparent mistake. They cannot change their decision. They cannot change their opinion. Therefore, this is not allowed. This is not allowed. Second, the High Court cannot interfere with the factual finding recorded by the lower authorities and tribunal without any valid reason. Correct. C. Till tribunal, it is a fact-finding authority, and High Court is subject to what? High Court is allowed to get into what? Get into only question of law, substantial question of law. Now, can High Court get into the facts which are determined by the lower authority without any valid reason? The answer is no. The High Court is doing what? The High Court is trying to poke his nose. Where? In the fact finding. In the factual issues which is determined by tribunal or lower authorities. Can they do so without any valid reason? Without any valid reason, they cannot do so. They do not have this power. Next one, we are supposed to compute one simple penalty question is there. Does not result from misreporting. If it is not a misreporting, it is a simple normal underreporting. Therefore, 50% penalty will be imposed. It's a company. The turnover of the company of last year is 350 crore. Therefore, the tax rate is 25%. Now, we are supposed to compute penalty. First, underreported income. How will we find underreported income? Income assessed under 143.3 minus income processed. So, income assessed is minus 5 lakh. Income processed is 7.5 lakhs minus. Therefore, the underreported income is 2.5 lakhs. Now, how will I compute tax? In case of loss cases, directly compute tax. Directly. In loss cases, we have to directly compute tax. On 2.5 lakh, 25% tax, 4% cess. That's it. On that, 50% penalty. Similarly, income reassessed, 4,50,000 positive. And income previously assessed, 5 lakh negative. Therefore, underreported income, 9.5 lakhs. Again, because it is a loss case, loss has converted to income, same logic. In case of loss, directly compute tax. On 9.5 lakhs, 25% tax, 4% cess. That's it. On that 50% penalty. I hope it is clear to all of you. Very simple question, nothing great as such. Question number 5. Question number 5, A1. There is a search operation which is conducted on the assessee on 31st of October. The AO has seized 25 lakh rupees cash. Okay. Now on 27th November. Okay. On 27th November, the assessee has made an application explaining the source of that 25 lakhs. Now the question is, will department return you that particular 25 lakhs? So there is a proviso which is given under 132B, which says that if any asset is seized by the income tax department during the course of search, and if you go and explain the nature and source within 30 days from the end of the month in which the search is completed. When is the search completed? The search is completed in October 25. You have to go within 30 days from the end of the month. That is till 30th November. You have gone when? You have gone on 27th November, so you are going on time. So if you go and explain the nature and source of that particular income, of that 25 lakhs, if you go and explain the nature and source of this 25 lakhs, till 30th November 2025, the officer will return you the asset by reducing the existing liability. Existing liability will take. He is not going to completely give you back. He will take the existing liability and rest of the amount he will give you back. Existing liability. Provided you should be able to satisfy the assessing officer. If the assessing officer is not satisfied with your explanation, then he will reject your application. It is not mandatory that he will always accept. If he accepts, he will return. If he rejects, then nothing can happen. Then wait for the assessment to complete. Sir, in how many days? If he accepts, sir, in how many days he will give? He will give within 120 days from the completion of search. When is the search completed? 31st October. So within 120 days from 31st October maximum, he will return you the assets by reducing the existing liability. This is what this provision is all about. I hope it is clear to all of you. Next question is whether GAR will be applicable or not. We need to answer that. See, there is one country, country X, and there is one country, India. Now, it is written in the DTAA between India and country X that if a country X company invests in Indian company more than 10%, then they will be liable to tax in India. So, if a country X company is investing in an Indian company more than 10%, then they will be liable to tax in India. So, they should not invest more than 10%. If it is below 10%, then it is not taxable in India. So, they want to invest in Indian company around 19-20%. So, what are they doing? If they invest 19-20%, which will be more than 10%, they will be liable to tax in India. So, they are not directly investing 19 or 20% in India. They are making two companies in country X. Lalit Limited, Mohan Limited formed in country X. So, now X Limited is holding company for Lalit, X Limited is holding company for Mohan, and they are telling Lalit and Mohan to individually invest 9.95%, 9.95% and in an Indian company, so that X country company is not investing more than 10% in Indian company and they can take the benefit of DTAA. So whether GAR can be applicable in this case, the answer is yes. There is no commercial substance of making Lalit Limited and Mohan Limited. The entire objective, the primary objective of making Lalit Limited and Mohan Limited is only to obtain tax benefit. There is no commercial substance. This entity lacks commercial substance. They do not do any other thing except investing in Indian company Red Chillies Limited. Therefore, the GAR will be applicable. The AO will disregard both the entity and will assume that X Limited has directly invested 19.9% and therefore tax will be charged in India. I hope it is clear to all of you. Next question is on whether the foreign company has a POEM in India or not. For that, we need to check the ABOI test. So, Mischief Limited is a company incorporated in Maldives. Now, they have given the data to us. So, what are the conditions to prove that the foreign company is passing the ABOI test? There are 5 conditions. First, the passive income should be less than equal to 50% of total income. Let's test the passive income. First of all, is the first income passive income? The answer is no. Why? Because in passive income, you should purchase and sell both from associate enterprise. Here you are selling to unrelated party. Therefore, this is not passive income. Second, also not passive income because here you are purchasing from unrelated party. You should purchase and sell both from related party. Third, you are purchasing both and selling both to associate enterprise. Therefore, this 5 lakhs and this 10 lakhs will come in passive income. Next, interest, dividend, capital gains, royalty and rent. These 5 incomes are always passive income. Therefore, this 20 and 15 is also passive. Therefore, how much is passive income? Total passive income, if I total, it is 50 lakhs, sorry, and divide by total income, if I do, it is 110 lakhs. How did I get total income? 25 plus 50 plus 20 plus 15, I will get 110 lakhs. Is it less than equal to 50%? The answer is yes, because it is less than equal to 50%. Condition number 1 fulfilled. What is condition number 2? The Indian assets should be less than 50% of total assets. The Indian assets are these assets: 120, 50, 40. Total assets are total of all of them. So the Indian assets are 210, total assets are 610. Therefore, Indian assets are also less than 50% of the total assets. Third, the Indian employees, which are 70, should be less than 50% of total employees. So the Indian employees are also less than 50% of total employees. Fourth condition, the payroll expense on the Indian employee should also be less than 50% of total expense. Yes, the payroll expense on Indian employees is 8 lakhs and the total employees is how much? 20 lakhs. Therefore, the payroll expense on Indian employees is also less than 50%. And last but not least, majority of the board meetings should be held outside India. So out of 8 board meetings, only 3 are held in India, 5 are held in Maldives. Therefore, this company will not be liable to tax in India because this company will be called as what? Having active business outside India. The POEM is outside India. Therefore, the status of this company is non-resident. I hope it is clear to all of you. They are fulfilling all the conditions of POEM. Is this clear? Let's move on to the third paper. MTP Series 1, September 2025. Now, the very first question is exactly similar to what we have done earlier. Same. All adjustments are copy paste. You can go and check all of them. We have done all these adjustments multiple times, not one times, at least 4 to 5 times we have done all these adjustments. I'm not repeating this question once again. It doesn't make sense. You also ignore, completely ignore, please. Don't touch also this particular question. Yes, second question is a good question which is coming for the first time in our 26 paper compilation. What is this question? This question is on partnership form. We need to find out the book profit. We need to find out the remuneration. We need to find out the total income. AMT is not required. No AMT. We are supposed to compute only under the normal provision. Okay, just normal provision. No AMT is asked. AMT is not computed. So first we will compute the book profit as per the provisions of 40B. So what is the net profit of the partnership firm? It is 95 lakhs after debit and credit of following things. Interest on capital we are giving 13%. So add back 1%. Only 12% allowed. Next, interest on loan from partner. Interest on loan from partner is also covered in 40B. It is also covered in 40B. You are giving 17% interest to partners. Partner is giving loan to the firm. Firm is giving interest. How much? 17%. Not allowed. Only 12% allowed. 5% interest add back. Now the next adjustment is very important. You are paying a royalty of 5 lakhs to a partner who is a professional script writer for use of his script. So you are using some script of the partner. The firm is using the script of the partner and paying a royalty. Whether this royalty can also come under 40B, the answer is yes. Take this also under 40. Because under 40B it is written that any remuneration, commission, bonus, salary By whatever name called, paid to partners can come over here. So by whatever name called can also include royalty. Therefore, this royalty will also come in 40B. Add back this and compute this under what? Under the total limit of 40B. Add back this also. Depreciation as per books of accounts, add back. Now next adjustment also very good. You have purchased the building in 2022 for 87 lakhs. I don't know for how much you have purchased. Today the WDV is 37.83 lakhs because it's a depreciable asset. You have purchased in 2022. Today the WDV is 37.83 lakhs. You are selling for 87 lakhs. The differential amount you have credited to P&L. First of all, reduce from PGBP. Reduce the PGBP and show under capital gains. It will be called as STCG. This was the only asset in the block. Therefore, the block ceased to exist. Therefore, short-term capital gains will be chargeable on you. So this is the amount, around 53, 52, whatever amount will come, 52 lakhs point something, that will be subject to tax under capital gains. But listen, when are you selling this? You are selling on 5th of November. And within 6 months from this date, you are investing what? You are investing in point number C, check, in National Highway Authority of India bonds, check, within 6 months. You are selling on 5th November, you are purchasing on 31st May, which is within 6 months, you are purchasing what? Your bonds. Therefore, you can claim exemption under what? 54EC. 54EC exemption can be claimed against long-term land and building. But sir, the gain is short-term, na? Gain is not relevant. The nature of asset is relevant. Remember, AS Builders case law. Is the asset long-term? Yes. The asset was purchased in 22, sold in 25. Therefore, the asset is long-term, it is sold after 24 months. Don't check the gain. Gain is not relevant. The nature of asset is relevant in 54EC. Therefore, you can claim exemption of 26 lakh rupees over here. And there are 4 partners. Only 2 partners are working partners. Be careful while computing the remuneration. Okay. Partnership deed authorizes the payment of interest and remuneration. Remuneration is 35,000 rupees per month. This is the actual remuneration. Remuneration is not debited to P&L. Great. If it would have been debited, we would have added back. Now, because it is not debited, we do not add back. Okay. Next one. You are opening some unit in SEZ, but you are late. You are opening in 2022. After 2021, nobody is going to get deduction under 10AA. Maximum, you have to open the unit by 31st March 2021. And the letter of approval should have been taken by 31st March 2020. Anybody who has taken letter of approval till 31st March 2020 and opened the unit till 31st March 21 can also claim deduction. But after 21, it is not possible. So this entire discussion is of no use to us. Okay. No use to. You cannot get deduction of this particular 10AA. Next, already done. 54EC exemption you will claim. After that, depreciation as per income tax law 27,000 you can claim. Then WDV of the car 9,70,000 rupees. On that you can claim 15% depreciation. Then second-hand machinery you are purchasing but put to use in November, therefore put to use for less than 180 days. Therefore you can claim what? 7.5% depreciation. Okay, not full 15%. After that you will compute your book profit. After that you compute remuneration, maximum remuneration, and compare with actual. Actual remuneration will include what? 2 partners remuneration 35,000 per partner into 12 into 2 partners plus in actual remuneration you should also add 5 lakh rupees royalty, because you are also considering royalty to be part of what? Remuneration only. You have to consider that also. Be very careful. And then you will compute your total income. I hope it is clear to all of you. Next question, similar. Just now we have done it. Check it please. For a national coming to play in India and is earning from playing, for whatever he is earning from playing, that will be subject to 20.8% tax, and whatever is earning from horse race and lottery, that will be subject to 30% tax. Just now we have done this question. Check it please. Nothing great. Question number 3. Let's start. Beautiful question. So there is a REIT business trust. We need to compute the total income of business trust, and also Mr. Arpan, which holds 70% in business trust. And there is also an SPV by the name called as H Limited. SPV does not, SPV has opted for 115BAA. So therefore this line is very, very critical for us. Be very careful. So there are 3 parties over here. One is REIT, which is known as Beta. Second is Arpan, which is the investor in the REIT. 70% is held by the Arpan only. He is a major shareholder. And H Limited is an SPV which opted for 115BAA. Now we need to compute the total income in the hands of REIT and Arpan. Let's see one by one. Interest from SPV exempt in the hands of REIT always, and taxable in the hands of investor, but only how much taxable? 70% taxable, because 70% is what? The holding of Arpan. Dividend from H Limited, dividend from SPV always exempt in the hands of REIT. But what about in the hands of Arpan? In the hands of ARPAN, it is taxable 70%. Why, sir? Because the SPV is opting for 115BAA. If SPV would have not opted for 115BAA, then this dividend income would have been exempted in the hands of ARPAN. Now, because SPV is opting for 115BAA, SPV is taking concessional tax rate. Therefore, the ARPAN has to bear the brunt of tax over there on that dividend income. Short-term capital gains on property, the business trust will pay tax at MMR, investor exempt. Interest on unlisted debenture, business trust will pay tax on MMR, investor exempt. Rent from direct property, business trust exempt, investor taxable 70%. Now you need to be very careful with this case now. Very, very intelligent part. Total how much money is distributed during the year by the business trust? Total 20 crore is distributed to all unit holders. All. Now you need to check. All these incomes are amounting to 20 crore or it is less than 20 crore. If it is less than 20 crore, it means 20 crore includes some repayment of debt also. You are paying over and above all these items, something repayment of debt that will also be taxable under 56(2)(10) new amendment, FA24 amendment. Remember or not? So if I total all of them, this 12 crore, this 2 crore, I want to total this. Total 12 crore, 2 crore, 1.2 crore, 12 lakhs, 2 crore. Total all of them, it comes to 17.32 crore. This is the total distribution of these 5 items, but actual distribution is 20 crore. Therefore, how much excess you are giving? You are giving 2.68 crore as a debt repayment to the investor. That will also be taxable in the hands of investor. How much? A plus B minus C, some formula was there. But out of that, Mr. ARPAN is getting only 70%. So only 70% will be attributed to ARPAN minus the ARPAN has purchased the units for how much? ARPAN has purchased the units for 1.5 crore. So the differential amount will be called as what? The debt repayment in the hands of ARPAN, which will be taxable under 56(2)(13). 37.2 lakhs will be taxable in the hands of ARPAN. Go and check. I hope it is clear to all of you. Beautiful question it is. You always have to check whether the total distribution is more than these points. If it is less than this point, then it is okay. But if the total distribution is more than this point, then there can be debt repayment concept. Also, you can check if whenever they will give you the issue price of the units acquired in the REIT, when this line is also given, there can be a debt repayment concept in your question. I hope it is clear. Next question is a DTAA question. Varun is an Indian citizen. He is 44 years. He left India for the first time in 23. Now he came back to India for some personal reason. Permanently he came back to India. Therefore, he is a resident and ordinary resident. Why? Because he came in June. From June to March, obviously he is staying for 182 days. He is a resident. Now, in 2023 only he went outside India for the first time. It means before that he was in India only. Therefore, he will easily fulfill the 2 additional conditions also. Therefore, Varun is a resident and ordinary resident. World income will be taxable in the hands of Varun. Now, Varun wants to pay tax as per new regime. So, accordingly compute tax as per new regime. First, Varun is earning income from rental, $48,000 on 31st March. Municipal tax is not there. So you will convert this $48,000 minus 30% standard deduction. Okay. Whatever income will come, you will convert this into Indian rupees as per rule 115 TTBR on the last day. TTBR on the last day is 86. So therefore 48,000 minus 30%, 48,000 minus 30%, you will multiply this by 86 rupees. You will get your 28,89,600 as your rental income taxable in India. What is the second income which is taxable? If rest all incomes are Indian incomes only. Business in India 9,40,000 that you can take under PGBP. Dividend received 337,500. This is net of TDS. So you have to gross up this dividend. So gross up this dividend. Divide by 90%. On dividend 10% TDS is deducted under 194 by domestic company. Therefore gross up this by 90%. You will get your gross dividend. Then saving bank interest 19,800 you can take under IFRS. 80 TTA will not be available because 80 TTA is not available under new regime. So only 4 incomes are there in Varun's income. So take the total of all 4 incomes: rental income, business income, other source 2 income. One is dividend after grossing up, don't forget, and one is interest income. This is your gross total income, no chapter 6A. This is your total income, compute tax as per new regime. Your tax is 88E1. Divide this by 442. You will get your 20.86% as your tax in India, average rate in India. Now we will find out the average rate in country. There is only one income where you are doubly taxed. So average rate in country. Which country it is? Country B. What is the average rate in country B, sir? See, how much tax he is paying? 48,000 is the rental income he is earning over there. But he is getting a basic exemption of $15,000 over there. Therefore, he is paying 20% tax in country X only on $33,000. So on $33,000, he is paying 20% tax. That comes to 6,600. So 6,600 is the tax he is paying. And the income in the foreign country is 48,000. So 6,600 is the tax. 48,000 is the income, multiplied by 100, so 13.75 is the average rate in foreign country. Therefore, the relief will be 13.75%, not 20.86%. I hope it is clear to all of you. This 13.76% he will apply on doubly tax income. Doubly tax income is 28,89,000. I hope it is clear. Is it clear? Check it please. Question number 4, which is on TDS, and one question is on transfer pricing, which we have done earlier. TDS question I will say. Generally, if I pay some insurance commission to the insurance agent, insurance intermediary, I am supposed to deduct TDS under 194D at the rate of 2%. In excess of what? In excess of 20,000 rupees. But if the insurance intermediary is located in IFSC and he is giving me a declaration that he is eligible to claim deduction under ATLA, then I am not liable to deduct TDS. Remember or not? There are long notifications. Multiple people are covered to whom if you make payment and if they are located in IFSC and if they give a declaration, then no need to deduct TDS. So this is what is happening in the first question. The agent is an insurance intermediary which is located in IFSC and you are making a payment of commission of 1,50,000 rupees to him, but do not deduct TDS because he is giving a declaration that he is claiming deduction under ATLA. Therefore, do not deduct TDS. I hope it is clear to all of you. Next question we have exactly done in question number 4B of Jan 26 paper. Go and check. Next question. Question number 5A1. What is this, sir? The AO has passed an order for AY 2425, but the typist, while typing the order number, he has written 2324. So the order is of 2425, but while making the order, the typist has made a clerical error, making it 2324. Because of this mistake, can you tell that the entire order is invalid? And can you deny paying the tax liability? The answer is no. There is section which protects the income tax department, 292B, not BB, 292B. 292BB is different. 292B, which says that if there is any clerical error, typographical error in the order or in the any notice, in any summon, then you have to ignore that fact. If the overall impact of the order does not change, if the overall purpose of the income tax law is not defeated, here the income tax purpose is not defeated. Just because 2425 is wrongly written as 2324, the entire purpose is not defeated. You have to ignore that fact and consider that as a valid order and pay the tax on time. I hope it is clear to all of you. Next question we have done earlier. Again, I will say once again, Reliance Communication. Can ITAT under 254 subsection 2 re-hear the entire matter? No. When you go and make an application to ITAT under 254 subsection 2, for what? For rectification. ITAT does not have the power to re-hear the entire matter once again. ITAT does not have the power to review its own order. ITAT cannot review its own orders. The first view should be the last view. They cannot take multiple views. Once they pass an order, they cannot change the order in future. Yes, only one thing is possible. Once they pass the order, in future, if there is an apparent mistake, they have to rectify. That's it. That's the only power with the ITAT, which was said by the Supreme Court in the case of Reliance Communication. Multiple case laws are there on this issue. Next question. Again, a good question. Green Tech Innovation is a resident company. They are planning to enter into some collaboration with a German company. For that, they filed an application to advance ruling in April 26. So, an Indian company wants to enter into collaboration with a foreign German company. For that, they have made an application to board for advance ruling in April 26. But later, it was revealed that this same Indian company, they have already submitted an application to AO for same matter in March also. In March also, 1 month before, you have already submitted a similar matter to the AO, same matter to the AO for determination of tax liability or tax implication. Now the question is whether the AAR will accept your ruling. The answer is no. It is very clearly written in the law that if your matter is already pending in front of income tax authority or ITAT or any court, the AAR will reject your application. In this case, your matter is already pending since March 26. You should have not come in April 26 to AAR. Your application will be rejected. First part is this. Second part, what is the remedy available? If you are agreed by the ruling of the board for advance ruling, if you are agreed by the ruling of the board for advance ruling, the only remedy is you can go to High Court, file an appeal in 60 days. Within 60 days from the date of receipt of BFAR order, you can file an appeal to High Court. If required, if circumstances so justify, if there is a genuine case, they will give you also an extension of another 30 days. Another 30 days extension can also be given by them. I hope it is clear to all of you. Next question is also a beautiful question on GAR. So pay attention. Very, very good question. There is country X here. There is India here. What is happening, sir? In country X, there is one company, Skyline company. In India, there is one company, Sunrise Limited. Now it is written between the DTAA between country X and India that if Skyline provides services to Indian company, they will be liable to tax in India. They will be liable to tax in India. But at the same time, it is written that if it is not company, instead it is a firm, then they will be liable to tax only if the firm has a fixed base in India, that is they have some P in India, or if the partners or employees stay in India for 180 days. Otherwise, it is not taxable. For company, it is directly taxable, but for firm, it is not directly taxable. For firm, they should have a branch in India, or their partners or employees should stay, or partners or employees, either of them should stay for more than 180 days. So the company did what? The company, instead of providing services through company, they made a firm. They made a firm and they provided the service through a firm to Sunrise Limited. They did not make any partner. They did not make any branch in India. Neither they have any partners or employees who are staying in India for more than 180 days. They are not violating these conditions. So therefore, whether GAR will be applicable, the answer is yes. GAR will be applicable because there is no commercial substance of making this partnership firm. The only objective of making this partnership firm is to take tax benefit. Therefore, the AO will disregard this particular partnership firm and will assume this partnership firm to be a company only, and therefore GAR will be applicable on the SSC. I hope it is clear to all of you. Next question. Mr. Pradeep is an interior decorator. Beautiful question this is also. His total receipts are 65 lakhs and the breakup of the receipts is also given here. Now he is contending that he will not get the books of accounts audited because his turnover is not exceeding 75 lakhs. He is ready to declare his income under presumptive income 4480A. Is he correct? The answer is yes, he is correct. How, sir? See, Pradeep's total receipts is how much? 65 lakhs. See, if your total receipts is up to 50 lakhs, you can definitely go for what? 4480A because Pradeep is an interior decorator. Interior decorator is covered in 4480A. But even if your total receipts is up to 75 lakhs, in that case also you can go for 4480A. If your receipts, cash receipts is up to 5% of total receipts. So if Pradeep's cash receipt is up to 5% of total receipts, then Pradeep can enjoy 4480A up to 75 lakhs also. And if he enjoy 4480A up to 75 lakhs, then he does not have to get his books of accounts audited. So we need to check whether the Pradeep is coming in that 5% limit or not. See, the total receipts of Pradeep is 65 lakhs. That I will take in the denominator. Now I will check how much is cash receipt. I will get two cash receipt in this entire statement. One is this one. This bearer check is also considered as cash receipt, sir. Yes. And check which is not an account pay check will be considered as a cash receipt only. Okay. So this bearer check will be considered as cash receipt. And here also see 1,22,800 is received in bearer check. That is also cash receipt. Apart from that, everything is online. This is online, 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 this is online. Rest all is online. Only these two payments, these two receipts are what? Cash receipt. If I total it, divide by 65 lakhs, it comes to 3.61%. Therefore, because it is up to 5%, Pradeep can enjoy 44ADA benefit up to 75 lakhs. Therefore, because he can enjoy 44ADA benefits up to 75 lakhs and he wished to claim presumptive income. He is not saying that he does not want presumptive income. He wished to claim presumptive income. Therefore, there is no requirement of audit up to 75 lakhs. I hope it is clear to all of you. So, this is what this paper is all about. Let's go ahead with MTP Series 2 September 2025. The very first question is on total income. Let's see what they are asking. They are asking total income and tax payable as per the normal provision. No 115BAA, no 115BAB, no MAT, nothing. The turnover of last year is 450 crore. Therefore, the tax rate will be 30%. Okay, now let's start with the discussion. Assess is a manufacturing company. Net profit is 68,50,000. Depreciation as per the Companies Act is 59 lakhs that you will add back. Then routine adjustment. There is some old machinery which has caught fire, so it is destroyed. So there is a loss of 19 lakhs. This 19 lakh loss is a capital loss, so add back this loss and this scrap value will be reduced from the WDV of the block of asset. So reduce from PGBP and reduce from the WDV of block of asset, but WDV of the block of asset is not given to us. So ultimate treatment is what? Very simple. 19 lakh rupees add back to PGBP and 9,10,000 rupees reduced from PGBP. Next is tax demand 8,40,000 including cess. So income tax department, income tax demand including surcharge and cess is disallowed. Therefore disallow this entire amount. Next is this, you are receiving some power subsidy from central government of 17 lakh rupees which was not credited to income earlier. Therefore it is a part of income as per 22418. Any subsidy received from central government government, state government body, agency, etc. It is income under 22418. Next one is an intelligent adjustment which is coming for the first time. Generally, interest income is where do we put interest income? Generally, we put interest income under IFRS, but in this case, interest income will not go in IFRS. In this case, interest income will go in PGBP. Why? Because it is interest earned on margin money deposited for securing bank guarantee. You want some bank guarantee which you want to give in business to your contractors, etc. So because you want some bank guarantee which you want to give to someone, and in place of that you have put some fixed deposit in the bank, and because of that fixed deposit you are getting some interest. This interest is not an independent investment activity. This interest is related to business. Therefore, this interest will be PGBP income. Let it be part of PGBP. Don't do anything. Next one, raw material 14 lakhs you are purchasing for in-house research and development, which is debited to P&L. It will be allowed as deduction. You are not claiming ITC on GST. Therefore, you will be allowed the deduction on this 2,75,000 rupees also. Okay. Next one, you are making some payment of 18 lakh rupees for online advertisement to Yulong Materials Limited, which is a non-resident with a P in India. Now, you are making some online payment to a non-resident. The non-resident also has a permanent establishment in India, and you are making payment to that non-resident. This income is accrued and taxable in India. Therefore, you should have deducted TDS. You have not deducted TDS. Therefore, 100% of this expenditure will be what? Disallowed under the income tax law. Next one is, you are receiving some dividend of 3,33,000 from foreign company. So, reduce from here and show under IFOS. And there is an expense of 19,000 rupees which is other than interest. So other than interest expense are never allowed against dividend. Therefore, add back this interest, add back this expense over here. So what is the ultimate treatment of this dividend adjustment? Reduce dividend income from here, show under IFOS. Add back expense, don't claim deduction under IFOS. Okay. Next is, you are taken some loan from PNB. On that there is an interest of 15 lakh rupees. Now you want to convert that interest into a new loan, or you want to convert that interest into a debenture. Therefore, conversion of outstanding interest into a debenture does not amount to actual payment. Therefore, this will not be allowed under the income tax law. This is also disallowed. Next, depreciation as per the income tax law will be allowed 43,20,000. Then you have purchased some printer of 92,50,000 rupees. On that printer, you will claim 15% normal depreciation, 20% additional depreciation. Then another printer you have purchased after 23rd October. So on this, you will claim half depreciation normal and half additional depreciation, 7.5% and 10%. And then some assets you have purchased after 30th October. On that, you will claim 50% depreciation. Lorry for transportation, you will claim 85 lakhs into 7.5%. Additional depreciation is not allowed on road transport vehicle. And one imported machinery for Hungary, which will not be subject to depreciation because it is installed in the next year. Okay. The turnover of the company is 450 crore. Therefore, the tax rate will be 30%. I hope it is clear to all of you. So this is what this question is all about. So let's go to the next question now. Question number 2. Question number 2 is a beautiful question of conversion of a private company into an LLP. If a private company is converted or an unlisted company is converted into LLP, then the provision of section 47(13)(b) is applicable. Now, what does 47(13)(b) says? First of all, first a private company was there, ABC Private Limited Company, and then that was converted into an LLP, ABC LLP on 30th of September 2025. Now, we need to tell the lot of tax implication. First, what will happen with the business loss? The business loss can be transferred to LLP for balance number of years from 1st April 2025. Earlier it was transferred for another 8 years, but now it can be transferred only for balance number of years. So the business trust can, so the business loss can be transferred to the LLP for balance number of years. Second, plant and machinery. Plant and machinery whose WDV was 14 lakh rupees. Ignore market value. Market value is not relevant. WDV is relevant. Take 15% depreciation on that and then bifurcate between both of them on the basis of number of days the assets are used by both of them. So from 1st April till 29 September, the company will claim depreciation, and from 30th September till 31st March, the LLP will claim depreciation. Next, plant and machinery, 75 lakh on which 3580 deduction is claimed. Therefore, now on this machinery, even the LLP cannot claim depreciation. In any asset on which 3580 deduction is claimed, that is not depreciable. That cannot be claimed as a depreciation even by LLP. Even LLP cannot claim depreciation on that. Next one, for building also same like machinery, claim 10% depreciation on the WDV, not on market value. The WDV of the predecessor, the WDV of the company becomes the WDV of the LLP, not the market value. Market value ignore. 40 lakhs into 10%, then bifurcate between both of them. Cost of land 80 lakhs. So this cost of land will become the cost in the hands of LLP. Whenever the LLP will sell the land, they will take 80 lakh as their cost of acquisition for the purpose of computation of capital gains. VRS. Total VRS incurred in 23, 24, 28 lakhs. Now VRS expenses are allowed over a period of 5 years. We all know that. Okay. Now in the current year entirely, it will be allowed to LLP. Entirely. In current year, don't bifurcate VRS. In the current year, entire VRS, that is 1/5 of 28 lakhs, that is whatever amount is coming, 5.6 lakhs will be allowed to LLP. Next years onwards, LLP will get, obviously, and past year, obviously, company was taking. Unadjusted MAT credit lapsed. Any unadjusted MAT credit will not be carried forward by the LLP, it is lapsed. Last but not least, depreciation. Depreciation can be carried forward by the LLP. UAD can be carried forward by the LLP. So these are the items, tax treatment, which we have to write for each and every item, and you will get the marks. 8 marks question, very great. Next question is a very simple question on transfer pricing. There is a company, Access Research Solution, which is providing scientific research services to various non-residents. One of the client is Emerald, which guarantees 12% of the total loan. So if one enterprise guarantees at least 10% of the total loans of another entity, then both of them are deemed to be a source enterprise. Therefore, transfer pricing provisions will be applicable in this case. Because both of them, because Access Research Solution and Emerald are deemed to be a source enterprise, the transaction between them will be deemed to be international transaction. This is part 1, very simple. Next, part 2. In part 2, you have to write the entire story of what secondary adjustment. Suppose the AO has done a primary adjustment of 440 lakhs, which is more than 1 crore rupees. And AO has passed an order on 31st of March. Assessee has accepted that. What are the subsequent compliances? Transaction is denominated in rupees. No repatriation of money till 31st March 2026. 1 year MCLR is 9% of SBI. So we have to write the entire provision of secondary adjustment. Because the AO has passed an order on 31st of March 2025, the assessee should bring back the money to India, repatriate the money to India within 90 days from the date of order. If the money is not repatriated to India within 90 days from date of order, then secondary adjustment will apply. Secondary adjustment, because the transaction is denominated in rupees, therefore the secondary adjustment will be also in rupees. 440 lakhs will be considered as deemed loan multiplied by 9% plus 3.25%. Because the transaction is denominated in rupees, 9 MCLR of SBI plus 3.25% will become your effective interest rate. On that, you will apply the interest rate, you will get your secondary adjustment interest. You have one more option, that you pay one-time additional tax of 20.9664 and get relieved. Once you pay one-time additional tax of 20.9664, that's it. After that, there is no need to pay any tax. I hope it is clear to all of you. Both the options are there. Whichever is more feasible, the assessee can go for that. Next question, question number 3, which is on exit tax. There is a trust, Helping Hand Foundation, which was registered under 12AB. Now on 1st April 2025, it got merged with another trust, which is not approved under 1023C or 12AB. Therefore, exit tax will apply. Exit tax will apply. For that, you need to compute accredited income as per Rule 17CB. On that, you will apply 34.944% tax. Accredited income is aggregate value of all assets minus aggregate value of all liability. In assets, land will be valued at stamp duty value or market value, whichever is higher. Therefore, you will take stamp duty value. Equity shares will be equity shares which are listed in a stock exchange. You will take the average on 1st April 2025. That is whichever is 85 plus 95 average. That is you will take 90. For preference shares, you will take market value. For corpus fund, you will not take corpus fund. Outside liability, you will take taxation, you will not take, and other small outstanding expenses you will take. After that, you will get your accredited income. All assets minus all liabilities, the difference will be subject to tax at 34.944%. Very simple question, bonus question it is. If it comes for 8 marks, it's a great win-win situation for you. Next is a very simple DTAA question. Very, we have done such questions earlier. You can check it once. If you want to do, you do it, or else I will recommend that you will ignore this. You ignore this, please. Don't waste your time. You have much better things to do in life. Next one is tedious question, in which part 1 we have not done earlier, part 2 we have done earlier. Now lot of questions will repeat. At least 70-80% questions will repeat from here. Now what is part 1? There is an agent, there is a distributor who is giving some commission to the lottery agents. So if the distributor is giving commission to lottery agent, are the distributor liable to deduct TDS? The answer is yes. Under which section? Under 194G, if the commission payment is more than 20,000 in the financial year, they are supposed to deduct TDS at the rate of 2%. Now here the commission amount is 1,20,000. You are making a payment of 1,20,000, which is more than 20,000. Therefore deduct TDS at the rate of 2%. I hope it is clear to all of you. Next question we have done earlier. Check it please. Very simple question. Next question is a very beautiful question. You should do this question. This is a must do question from the MTP. Because this is the only question on Vodafone case law. This is the question on Vodafone case law. Very, very good question. Now, there are three things which we need to understand. Eco Pack Solutions Private Limited is an Indian company. It is in India. It is similar to HEL, Hindustan SR Limited. Do you remember that Vodafone case law HEL? Then there is Green Core Global, which is in country Zeta, which is similar to CGP, Mauritius company. And in this company, in this Green Core, there are two shareholders, Lucas Pereira and Daniel Zhang. Both of them are citizens of foreign country. They hold 50% each. So Lucas and Daniel are in what? Are in foreign country. They are holding shares of Green Core, which is also a foreign company. Now that Green Core is holding some shares in Eco Pack Solutions Private Limited. So if Lucas and Daniel is selling the shares of a foreign company, whether the shares of the foreign company will be subject to tax in India? Yes, they will be subject to tax in India if they derive their value substantially from asset located in India. So if the shares of Green Core derive its value substantially from asset located in India, as per explanation 5 to section 9, then it will be deemed to accrue or rise in India. Then how do you find out whether it is deriving substantially its value from India or not? For that, first of all, we need to find out specified date. Specified date can be two dates. It can be either the date on which you sell these shares or the last balance sheet date of Green Core. What is the last balance sheet date of Green Core? It is 31st December. You can check it. So this 31st December 2025 is not relevant. The specified date can be either the last balance sheet date, that is the balance sheet date which comes prior to the year of sale. Year of sale is June 25. Last balance sheet date is December 24. The specified date can be December 24 or June 25. But between two, which is the specified date? By default, you should take December 24 as specified date. But if the book value of the asset increased by more than 15%, the book value of the asset increased more than 15% of Green Core, then the specified date will become the date of transfer. So what is the book value of asset on 31st December? It is 2000. Check. This is the Green Core book value of asset. What is the book value of asset on the date of transfer? It is 2600. Is it increasing by more than 15%? Yes. Therefore, you will take the specified date as 1st June, not as what? 31st December. If the book value of asset would have been below 15%, then we would have taken 31st December as your date of what? Specified date. Now, so specified date is 1st June 2025 because the book value of asset as compared to the last balance sheet date is increasing by more than 15%. Therefore, this date is not relevant. Now, on this date, I will check whether the shares of Green Core derive its value substantially from asset located in India or not. So, how to determine that? For that, there are two conditions which Green Core has to fulfill. First, the investment in India should be more than 10 crore rupees. And the investment in India as compared to the total investment should be at least 50%. So how much investment they have made in India? They have made an investment in India of 1200 crore. Check please. Fair market value of assets in balance sheet of Eco Limited. At this time you need to check the FMV. See, always remember, while computing this specified date, you have to take book value. But while finding out the substantial value, you have to take the FMV without reduction of liabilities. So how much is the FMV of the assets of Green Core in Eco Shares Private Limited? 1200 crore. How much percentage it is of total assets of Eco Solutions Private Limited, of Green Core Global? 1200 is the investment in Indian company. 2200 is the total assets market value of the Green Core. Therefore, this is greater than equal to 50%. Therefore, two conditions are fulfilled. Condition number 1, investment in India is more than 10 crore. And investment in India as compared to total investment is greater than equal to 50%. Both the conditions are fulfilled. Therefore, the shares of Green Core Global derive its value substantially from asset located in India. Therefore, Lucas Pereira and Daniel Pereira, if they are selling the share, they will be liable to tax in India. I hope it is clear to all of you. Beautiful question it is. Beautiful question. Question number 5. Part A we have done earlier. You can go and check. Reference I have given over here. Part B, we have not done earlier, but it is a Supreme Court judgment of SAP Labs India Private Limited. What does this say? Can High Court come in between and determine the arm's length price? See, determination of arm's length price is the pure question of fact. It's not a question of law. So the question is, can High Court come in between and determine the question of fact? The answer is no. But can High Court come in between and tell the department and tell the tribunal that you have not computed the arm's length price as per the income tax department, income tax rules and regulations? See, ultimately arm's length price is determined as per the provisions of 92C and its rules, Rule 10CA, Rule 10CA. All these rules are applied. So can High Court come in between and say that the Income Tax Department or the SSC or the tribunal or any authority below that has not computed the arm's length price as per the Income Tax Act and its rules? Yes, that High Court can say. High Court will not come in, compute the arm's length price, but High Court definitely has the power to interfere in between and tell that the arm's length price are not computed as per the Act and the rules. I hope it is clear to all of you. Next question. The Indian branch of Slack Private Limited, they have done some transaction with a foreign company. The value of the transaction is 600 crore. Now they are asking for the fees. How much fee they are supposed to pay? See, if the transaction value is more than 300 crore, you have to pay advance ruling fee of 10 lakh rupees. If it is more than 300 crore, if it is up to 100 crore, then 2 lakh rupees. Above 100 crore, up to 300 crore, 5 lakh rupees. Above 300 crore, 10 lakh rupees fees you are supposed to pay. This is the first question. Second, same question repeated. If you are not happy with the order of BFAR, what is the remedy? Go to High Court within 60 days, 30 days extension will be given to you. Very simple question. Again and again they are asking the same question. Now next question is a good question on Bitcoin. You are purchasing 5,000 Bitcoin for 50,000. Now you are selling 2,500 Bitcoin for 25,500. So there is a profit of 500. How, sir? See, if 5,000 Bitcoins cost is 50,000. So what is the cost of 2,500 Bitcoin? 25,000. Cost is 25,000, you are selling for 25,500, therefore 500 rupees is gain. Multiply by 2,500 units. Similarly, another 2,500 you are selling for 28,750. So again there is a profit of 3,750 per Bitcoin. Why? Because the cost of 2,500 units is 25,000. Because the cost of 5,000 units is 50,000. So 25,000 is the cost. You are selling for 28,750. Therefore the gain is 3,750. Pay 30% tax. Expenses not allowed against the virtual digital asset. Expenses are not allowed. Expense on transfers are disallowed. Sorry. What about NFT? Same. 10,000 NFT you are purchasing for 1,50,000. You are selling 6,000 NFT means 60% for 89,000. So the cost of 60% comes to how much? 90,000. But you are selling for 89,000. There is a loss. This loss is lapse. You cannot set off this loss against Bitcoin. Not allowed. Not allowed. Not allowed. Get loss. Not allowed. Expense also not allowed, losses also not allowed. Another 4,000 you are selling for 56,000. What is the cost of 4,000? The cost of 4,000 is 40%. 4,000 is 40% of 10,000. So 40% of 1,50,000 is 60,000. The cost is 60,000. You are selling for 56,000. Therefore 4,000 is loss. Again this loss you cannot carry forward and set off. I hope it is clear to all of you. This is lapse. Not allowed. Next question we have done earlier. Go and check later on. Question number 6A1 of May 2024 paper. Okay, I hope it is clear to all of you. Lord, let's go ahead with the next one, that is MTP series 1 Jan 2026. The very first question is exactly copy paste from question number 1 of RTP May 2025. I'm not going to repeat this again and again because most of the things are now copy pasted. This question is also copy pasted from same as question number 1 of November 2023 paper. You can go and check. This question is also repeated, same as DTAA question earlier. This question also repeated, this question also repeated. Most of the things now are going to be repeated now. This question also repeated. Now, this question is slightly new question which are not repeated in the 26 paper so far. So I will talk about it and it's a very, very important question. Now, this C question will come once again in the next MTP. So from here they have copied in the next one. So what is this question? There is a total income. We need to compute total income and tax liability of Winter INC, which is a non-resident. Let's try to understand and compute the total income of this company, which is a foreign company, which is a non-resident. Dividend 1,25,000, 12,50,000, 20% tax plus cess will be applicable as per 115A. Second, this non-resident and foreign company is providing some technical know-how to an Indian company of 20 lakh rupees. So Indian company is receiving technical know-how and instead of paying 20 lakh rupees, they are giving dividend of 20 lakh. They are giving debentures of 20 lakh rupees to foreign company. So the foreign company is providing me technical know-how and I am giving them debentures. I am not giving them money. This will be taxable at what rate? This will be taxable at 35% tax. Sir, why sir? Why not 20% tax under 115A? 115A cannot be made applicable here because there is no agreement between both of them which is approved by central government. If there would have been agreement between both of them which would have been approved by central government, then I would have applied what? 115A. In this case, I will not apply 115A. Sorry. Here I have to apply normal tax rate 35%. But one more thing will come. Because I am also giving debentures, I am not giving money. I am not giving 20 lakhs money. I am giving debentures. So a debenture interest will also be taxable in India. That is for 6-month interest on 20 lakh rupees 8%. That will also be taxable at 35%. Sir, this interest also cannot come in 115A. No, this cannot come in 115A. You cannot tax this interest also at 20% because this loan is not given in foreign currency. This is given in Indian currency. Therefore, this debenture is in Indian currency. Therefore, this will not be subject to 115A. This will also be subject to 35% tax on interest. Next. Dividend from GDR is taxable at 10% under 115 AC. Next, normal business income at Mumbai will be taxable at 35%. And last but not least, royalty of 10 lakh rupees in pursuance of an agreement which is approved by central government. Yes, this can come under what? And it is other than 44DA. Yes, this can come under 115A. This will be subject to 20% tax or DTAA, whichever is lower. DTAA say 20%, income tax say 20%, DTAA say 22%, income tax say 20%. Therefore, now this can come under 115A. The reason is very simple, because there is an agreement which is approved by central government. In point number 2, there was no agreement which was approved by central government. Therefore, point number 2 cannot come in 115A, but point number 5 can come in 115A. I hope it is clear to all of you. Next question is a copy paste question. You can check it please if you want. The question after that is a new question, but it's a very simple question. Mr. Suhas is aged 43 years. He is working in a company with a salary of what? 85,000 rupees per month. Now he is also having a housing loan interest of 1,95,000 rupees self-occupied interest. Now he wants to follow old regime. Now you are supposed to compute the tax of Mr. Suhas. So you will compute the tax of Mr. Suhas under 192. How much tax? How we will compute the tax? You will take his salary 85,000 into 12 minus 50,000 standard deduction. From that you will deduct house property loss because he is following old regime. So you can claim house property loss under old regime. 1,95,000 rupees will be allowed as deduction. Once that is taken as deduction, after that compute total income, compute tax, and then find out how much tax can be deducted in case of Suhas. As simple as that. Nothing great as such. Next question we have done earlier in RTP 2025. This question we have done. I am giving reference. I am not just talking in air. I am not talking in air. I am giving reference of each and every question which we have done earlier. This question we have done. This question we have done. This question we have done. We have done all this question. This question we have done. This last question is pending. That I will do now. And this question is also not done earlier. So I will do that. Okay. What is this question? 292 BB. Question number 5A1. Assessee filed a return on 25th of October. That is in 24-25 assessee has filed a return. The department has sent a scrutiny notice on 9th of July 2025. The assessee responded to the notice. Whether the service of notice is in time, if not, whether the assessment order can be challenged by the assessee. Now let's see what is happening. When is the assessee filed the return? 24-25. 25th October 2024, that is 24-25. When the notice was served on 9th of July. 100% is late. Because the time limit to serve notice under 143(2) is within 3 months from the end of the financial year in which the return is filed. So return is filed in 24-25. So within 3 months from the end of the financial year is 30th June 2025. By this date, the department should have served the notice, but the department has served the notice on 9th of July. So it's a late notice. Now, there are two possibilities. If assessee has cooperated, then it is deemed to be valid. Because 292 BB will attract. And if the assessee has challenged before completion of assessment, then it is not deemed to be valid, then it is an invalid notice. Then you can challenge the assessment order also. Remember, if a notice comes late or if a notice comes improper, you should challenge that. You should challenge that. If you challenge that, nobody will raise any question. But if you don't challenge, if you cooperate in the assessment and if you let the assessment order get passed, after that if you raise any question, it is deemed to be valid notice. I hope it is clear to all of you. And one last question is on tax audit. What is happening in this question? Beautiful question on tax audit. On 20th of February 2025, there was a search conducted in a jewelry shop, Usha Jewelers, where it was found by the income tax department that huge payments are made in cash for purchasing golds, violating the provisions of 48(3). We all know that if you make a payment of more than 10,000 rupees to any person in a day, you should make by 4 modes. Assessee has made 18 crore rupees payment of gold purchase in cash. Some of the clients were asked, their response were recorded. Okay. Most of the golds they purchase is in cash and it is in excess of 10,000. When we ask the chartered accountant what the hell you have done, he has reported in the form 3CD that I have taken the management instruction. Management has given me a representation letter that they have not made payment in excess of 10,000 rupees. I have also done test check. I have not found anything. You have taken management representation that no payment are made for more than 10,000 rupees. You have taken an instruction from the management that we have given strict instruction to the employees, then don't make payment of more than 10,000 rupees in cash. You have also done test check. You have not found a single payment of more than 10,000. That is the reason I have not qualified. This is what the argument of the assessee of the chartered accountant is. No, it is wrong. First of all, the chartered accountant should understand that only taking a management representation letter does not fulfill his responsibility. Then everybody will do one thing, will go for the audit, will take management representation letter, will go home and say that audit is done. Management will always say that everything is correct. Management will never say that there is some problem in the industry. Therefore, it is your duty to check the transaction properly. Considering the nature of business, the assessee is engaged in the business of what? Gold. Cash is a very primary thing in this business. Therefore, because the cash is very primary thing in business, you should have checked each and everything very properly. Definitely giving the argument that management representation letter was taken, its standing instruction of the employees has been seen, I have done test check is not sufficient evidence. Therefore, a chartered accountant in this case is deemed to be guilty under the Chartered Accountant Act 1949. I hope it is clear to all of you. He will be held responsible. Nobody can escape you. Nobody can save you. Let's talk about MTP Series 2 Jan 2026. Question number 1, repeat. Check it please. Same question. Question number 1 of RTP 2025. Same. Question number 2, repeat. 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 Now question number 3 is slightly new. Let's see what is there. No, this is also repeat. Sorry. This is also repeat. This is also repeat. Go and check. I have given the reference. Yes, this question is slightly new. That is 3B. What is there in this question? Let's see. The trust claims that anonymous donation received by the firm by them are not liable to tax under 115 BBC. Part 1. A charitable trust applied the entire anonymous donation for the purpose of the trust. Wrong. If I am a charitable trust, then provisions of 115 BBC is applicable, and if 115 BBC is applicable, whatever anonymous donation I have received, even if I apply for the objects of the trust, I cannot claim exemption. Only one exemption is allowed for charitable trust from anonymous donation under 115 BBC, that is 5% of total donation or 1 lakh rupees, whichever is higher, that much you can claim as an exemption. Rest you have to, even if you apply, it doesn't matter, it will be subject to 30% tax. So the argument made by the trust that anonymous donation received, we have applied the entire amount for the objects of the trust is not correct. Even if you applied the entire amount for the objects of the trust, you have to follow the provisions of 115 BBC and pay 30% tax. Will your answer change if the assessee is a wholly religious trust? Yes, the answer will change now. Why, sir? Because if the assessee is a wholly religious trust, then the provisions of anonymous donation 115 BBC is not applicable to a trust which is wholly religious. It is only applicable to a trust which is wholly charitable or which is partly religious and partly charitable. If a trust is wholly religious, then the provision of anonymous donations are not applicable. So in that case, it will be treated like a normal donation, add to the income statement, claim 15% exemption, and remaining amount you can apply and claim exemption. I hope it is clear to all of you. Next question is a simple question, very simple question of DTAA. Mr. Ashu is a resident, aged 25 years. There are two important points which I am saying in this question. Rest of them are very similar to what we have done so far. Ashu is opting out of default regime, means Ashu is following old regime. Now, Ashu is earning royalty income of 18 lakh rupees. But you will not take 18 lakh rupees because Ashu is following cash system of accounting. Therefore, you will take only that much royalty which is received. First important point is this. You will only take 13.6 lakh royalty which is received. Second, Ashu cannot claim 80 QQB deduction. Why, sir? Ashu is following old regime, na? 80 QQB cannot be claimed. Why? Because Ashu is writing articles in journals and newspapers, and if you write articles in journals and newspapers, 80 QQB is not available. 80 QQB is available if you write some books which are artistic in nature, literary in nature, scientific in nature, not textbooks or notebooks or journals or newspapers. 80 QQB is not available. Be very careful. This is the second important thing. Apart from that, nothing great is there in this question. Rest is very simple. Ashu is earning. Therefore, in PGBP, what you will take? Only 13.6 lakhs. No 80 QQB deduction. Don't take 18 lakhs. Okay. Second, rental income 3.6 lakhs. You can reduce 12 lakhs, so 12,000 rupees standard municipal tax, 30% standard deduction. So rental is very normal. Dividend, you can take dividend which is 5.5 lakhs, which is received, and gross amount it is given. So you take directly 5.5 lakhs, and then some repayment of education loan you have taken for your son. for your MBA course. For that you can claim interest deduction under ATE. It's a very simple question. Compute tax rate in India, effective tax rate in India, and then find out the doubly tax income. Doubly tax income is only income. Doubly tax is your royalty income, and second income, which is doubly tax, is your rental income. Apply that 15% or average rate in India, whichever is lower on the doubly tax income. Okay, nothing great as such. Question number 2. 4A1 is something which we have done earlier. 4A2 we have not done earlier, so I will speak about 4A2. Sir, what is happening in 4A2? There are 4 people in 4A2. There is a patient who is going to hospital because he is not well. He is admitted in the hospital. Now, after he was released, so the hospital has given a bill. The patient is saying that don't give me the bill, give the bill to the insurance company. So the hospital has given the bill to the insurance company. Now the insurance company has given the bill to whom? To the third party administrator. And now the third party administrator is clearing the bill on behalf of hospital. So if a third party administrator is settling the claim on behalf of the hospital and making the payment to the on behalf of the insurance company and making the payment to the hospital, that will be subject to TDS under 194J. Remember or not? If the third party administrator is settling the claim and making the payment to hospital on behalf of insurance company, 194J TDS is applicable at 10%. I hope it is clear. This question we have done earlier. Go and check. Go and check. I am giving the reference. This question done earlier. This question done earlier. This question done earlier. Go and check. All these questions are done earlier. All of them. All of them. All of them. All of them are done earlier. Go and check. All of them. Now we will come to May 2026 MTP. Let's see what ICI has done in your attempt MTP. May 26. Have they done anything new? Let's move on to the MTP series 1 May 2026. Question 1, number 1, repeat. Check. Same question we have done earlier. All adjustment repeat. None of them are new. All of them are repeat. Question number 2, repeat. Same question. This. Same question we have done of slum sale. Do you remember? Chemical unit, textile unit. Same. They are not putting any efforts in making new MTPs. So always remember, most of the students get confused by looking at MTP. They go and solve ICI MTP in the center. They write the paper in the center and then they feel, yeah, I've got 70 marks in DT. I've got 80 marks. Such an easy DT paper. I can easily score 70 to 80 marks in DT. It's not that easy. It's not a cakewalk. The MTPs are always going to bluff you. They are not going to give you the real picture. The real picture will come from RTPs and past paper, not from MTPs. Always remember. So by solving ICI's MTP, don't be under an impression that you know everything. No. You might know everything. I am not saying you don't know anything. I know that you know everything, but you are not going to get the same level of paper in the examination. Be very careful with that. Even the easiest of the easiest paper in the CA final exam is not like MTP. It is still tougher than MTP. In MTP, they just do one thing, that is a copy-paste activity from last papers. Only copy-paste they do. They don't have any time to make new paper also. Only copy-paste they are doing. Question number B is a new question. Let's see. Mr. Karan Verma is aged 32 years. Now we are supposed to compute Karan Verma's total income under the new regime. Let's see what all things will come in Karan Verma's total income. New regime, salary 23,70,000. From that you will take 75,000 standard deduction. Interest on self-occupied property not allowed in new regime. Dividend will go under IFOS. Fourth point. He is making some FD in the name of her wife, of his wife. And she is earning some interest. So if I am making some FD in the name of my wife, that interest will be clubbed in my hands only, because that is my income, not wife's income. That will be clubbed in the hands of the husband. So you have to club that. So these are the domestic incomes. Now foreign incomes. He is earning some income from country R, 13,500. Business income multiplied by 90 rupees is the rate of euro. Then rental income is 8,000. So multiply by 90 minus 800 rupees municipal taxes minus 30% standard deduction. You can take that. Then short-term capital gains of 6,000. That's it. It's a very simple question. Nothing great as such. Then find out the average tax rate in India. And then apply that average tax rate. Compare that with foreign tax rate is 25%. Find out average tax rate in India and apply that on doubly tax income. Very simple question of DTAA. Nothing great as such. Next question. Repeat. Now the next question is a good question. We have done a question earlier like this, but this is one step ahead of that. Let me tell you, Tide Limited is an Indian company and Limitless Limited is a company, foreign company, which is located in NJA. We are selling some goods to a company located in NJA for 9.5 crores. So if an Indian company is selling some goods to a person located in NJ, then both of them are first of all deemed to be a social enterprise. Second, the transaction between both of them are deemed to be international transaction. Therefore, we need to find out the arm's length price. So we need to find out comparable. Now in the market, we are getting two comparable. To others, we are selling for 10.5 crore to XYINC and 11 crore for RPINC. So we are getting two comparable. So 10.5 crore we are selling. See, to Limitless Limited we are selling at what price? At 9.5 crore. To others we are selling for 10.5 crore to one company and 11 crore to one company. But there is a difference in transaction between both of them. This 10.5 crore and this 11 crore includes two things which 9.5 crore does not include. So you have to remove those two things. Insurance freight is included in 10.5 crores and 11 crores. So remove insurance and freight. Then after sales service cost is also included in this. Remove that also. So now we are getting two arm's length price. Remember, if you are getting more than one arm's length price, then you have to follow range concept if the number of items are 6 or more. If the number of items are 6 or more, you are supposed to follow range concept. But here the number of items are not 6 and more. Here the number of items are less than 6, only 2 items. So you can take arithmetic mean of these 2 items. That will become your arm's length price. So 10.19 first arm's length price, 10.69 second arm's length price divided by 2 will be your average arm's length price. You will compare that with 9.5 crore, then difference amount you have to add back. And one more thing, generally whatever the difference you will get, if that is less than 3%, then you don't have to apply transfer pricing provision. But in case of NJ, you don't have to check 3% also. Remember, in case of NJ, you don't get the benefit of 3% margin. Here the difference is more than 3%, but I am just telling you for the sake of safety in future, they might test you this also. So here, if you take the average and if you compare with 9.5%, the difference is more than 3%. But even if it is less than 3%, still you will take the arm's length price. You will not take the actual price because the person located is in NJ. For NJ, 3% margin is not available. I hope it is clear to all of you. Next question. Serious question. Question number 1. Madhav is an individual whose business's turnover of last year is 3.2 crore. So Madhav individual last year business turnover is 3.2 crore. He is making a contract payment for repair of his house for 3 lakh rupees. So 194C will not apply for personal purpose. 194M will also not apply because the payment is not more than 50 lakhs. I hope it is clear. 75,000 rupees is paying commission for business. Yes, for because the commission is more than 20,000 rupees, therefore 194H will apply, and Madhav's last year turnover is more than 1 crore, therefore 194H is applicable to Madhav. Second question we have done earlier, you can check it. Okay. Third question. Question number B. You have taken on sublease building for 20,000 rupees per month and machinery for 18,000 rupees per month. Will you deduct TDS? The answer is no, because the aggregate payment does not exceed 50,000 rupees, therefore no TDS. Under 194I, new limit is set. Under 194I, earlier what was the limit? Till last year, the aggregate limit of the entire year was 2,40,000. Now, the monthly limit of aggregate monthly limit should be more than how much? Monthly limit should be more than 50,000. Here the monthly limit is only 38,000. Therefore, no TDS will be applicable over here. Here this point number C we have already done earlier. So ignore that. Okay. Now question number 5. There are 2 case law questions. Both of them we have not done. So we will talk about both of them. First is CIT versus AA Estate Private Limited. What is this case law, sir? There was an assessee who lost the case. Okay. Therefore, they filed an appeal to High Court. So, assessee lost the case at tribunal. Therefore, they filed an appeal to High Court. Now, when they filed an appeal to High Court, they obviously gave their substantial question of law. What is the question of law on which they want to appeal? So, assessee gave proposed the question of law. That this is the question of law on which we are supposed to appeal. Now, the High Court gave a judgment without framing the question of law at its end. High Court just relied on the assessee's question of law and gave the judgment. High Court itself, suo motu did not frame any question of law. So the question is the High Court liable to suo motu also frame a question of law? The answer is yes. The court said that there is a difference between the question proposed by the assessee and the question framed by the High Court. The assessee has to frame question under 260A3 and the 260A2, and the High Court has to frame a question under 260A3. Both the subsections are supposed to be fulfilled. A2 is to be fulfilled by assessee, A3 is supposed to be fulfilled by the court. Without High Court framing the substantial question of law at its end, it cannot give the judgment. Therefore, the judgment is invalid. Assessee has to propose the question. High Court has to frame the question. Both the question has to be matched, and then the judgment has to be given. The High Court has not done the homework. Therefore, the judgment is incorrect. Next question which we have done it in our question bank also, if you remember. The assessee filed return of income, declaring income of 10 lakh rupees. His case was selected for scrutiny and the AO added 4 lakh rupees during the assessment. Now during the assessment, assessee came to know that he forgot to set off losses of 8 lakh rupees of last year. Now assessee also knew that the time limit for filing the revised return also expired. So some 8 lakh rupees loss he forgot to set off and the time limit to file revised return also expired. Will the AO allow this loss? The answer is yes. There are two supporting things for the assessee. One is a Supreme Court judgment of 1985 and one is a CBDT circular of 1955 which says that the duty of every assessing officer is to compute correct total income. And if any assessee has failed to claim any losses, then it is the duty of the assessing officer to allow that loss and give that as a deduction. The objective of the assessing officer is to make correct assessment and is to help assessee, particularly in claiming deductions, claiming losses, claiming benefits. You have to assist the assessee. You should help the assessee in claiming the deductions and benefits and not disallow the losses just because the assessee forgot to claim the losses. Therefore, such losses will be allowed as deduction, don't worry. A CBDT circular of 1955 is there and Supreme Court judgment of 1985 is there. Next question we have done earlier, you can go and check. Next question we have done, done all these questions we have done earlier, you can go and check. This question just now we have done, if you remember. If you remember just now, we have done. Okay, same question only. Only one question is pending over here, whether GAR will be applicable in this case or not. The assessee has made an investment in a company on 1/4/2016. I am not interested in reading the question ahead because if you have made an investment before 1/4/2017, do you remember in the chapter of GAR, I have told you very first thing that GAR is applicable only if the transaction is entered on or after 1st April 2017. Now in this case, if the transaction is entered before 1/4/2017, then GAR will not be applicable. Therefore, in this case, GAR will not be applicable. I hope it is clear to all of you. So this is what this paper is all about. So have you seen that most of the question in this paper are repeated by the ICAI from where? From their own RTPs, MTPs and past paper. They are not ready to put efforts to make new MTPs. That is the one of the reason they were irritated with 3 attempts. That in every 3 attempts we have to make MTPs, 2 MTPs, then RTPs we have to make every 2 months. Then we have to make question paper, then students pass, fail, etc. Again and again. Board of Studies was irritated. Making question paper of CA final is not an easy task. Yes, CA Inter, CA Foundation question paper making is slightly easier. I am not saying that is very easy. Slightly easier compared to CA final question paper. Therefore, they have discontinued 3 attempts and again come back to 2 attempts. They don't have any brains. Whenever they feel like they make 3 attempts, whenever they feel like they make 2 attempts, whenever they will feel like they will make 4 attempts, whenever they will feel like they will remove IBS, whenever they will feel like they will put up one more subject like IBS. Anything can be done. There is no consistency. There is no certainty in the minds of the student. Hopeless people. Anyways, coming to one last MTP series 2, May 2026. What is happening in this question? Let's see. SS Limited is an listed company. And this is a beautiful question. We have not done this question earlier, so we will do it. They are engaged into 4 different kind of businesses. Now, what are we supposed to compute? We are supposed to compute lot of things. We are supposed to compute total income and optimum tax liability. Therefore, we need to follow 115BAA. Also, book profit is also given. So, we will make 3 computations. First, total income and tax as per normal provision. Then, as per book profit. Then, we will compare that with 115BAA. Let's start with the first business. The first business is a chemical unit in Hisar. The net profit is 300 lakhs. They have made a total payment of 40 lakh for royalty, but out of that 40 lakhs, on 10 lakh royalty, they have failed to deduct TDS. So this 10 lakh rupees will be subject to 30% disallowance because TDS is not deducted. Now they are doing some emotional story over here. The pay has included this as an income and file is returned before the due date. So what should I do? Still, in the current year, I have to disallow 30% of 10 lakh. In the next year, I can claim the deduction. But in the current year, I have to disallow this 30% of 10 lakh. So 300 lakhs is the net profit, add 30% of 10 lakh, and then one more thing we are paying in case of Hisar unit, 1 crore 68 lakhs we are paying as a contribution to notified pension scheme, which is 15% of basic salary plus DA in terms, 15% not allowed, only 14% allowed under PGBP, therefore 1% add back 1%. So this will give you your chemical business profit. Second, Faridabad unit is a manufacturing unit, furniture manufacturing, net profit 90 lakhs. You are purchasing some trademark of 25 lakhs on 1st June. Wrong. Add back trademark and claim 25% depreciation on trademark. Trademark is an intangible asset. You cannot claim full trademark as reduction. Add back 25 lakhs and claim 25% as reduction. Then you have taken loan from non-resident, paid interest of 3 lakh rupees, deducted TDS in March and remitted in May. So everything is correct. You are deducting TDS in March, which is before the financial year, and paying in May, which is before the due date of filing of return. Therefore, this expenditure will be allowed. Next is you are paying some 7 lakh rupees tax on non-monetary perquisites of employees. So tax on non-monetary perquisites of employees are disallowed under section 40A5, not allowed, disallowed. Third one is fertilizer production unit in Surat. This will be subject to 3580 deduction. 3580 deduction will be allowed. Now how much profit is there? 220 lakh is the profit, which is after depreciation. So add back depreciation. In 3580 depreciation is not allowed. Add back depreciation and claim the capital expenditure. Land not allowed, building fully claim and machinery also fully claim. So add back depreciation and claim fully building, fully machinery, land not allowed. Fertilizer unit done. Fourth one is warehousing facility for storage of edible oil. Storage of edible oil is not covered in 3580 because edible oil is not an agricultural product. Therefore, this is a normal business. Now, this is the net profit of 70 lakh, which is without depreciation. So, claim depreciation. On building, you will not get depreciation. On land, you will not get depreciation. On building, you can claim 10% depreciation. So, remove 10% depreciation from this. And on machinery, you can claim what? 15% depreciation. Additional depreciation not allowed because you are not doing manufacturing, you are doing warehousing. After doing all these things, they have given you one more information that company has raised some application money and they have put this application money in what? In bank. And from bank, they are earning interest of 3,20,000. What should I do with that interest? So the Supreme Court of India in the case of Rama Multitech Limited has held that the amount received from shareholder in the form of application money and put in the bank. And from there, if you earn interest, you should set off that against your public issue expenses. Don't show that as an IFRS income. You should set off that as a share issue expense. Against share issue expense, you can set off. Don't show that as an IFRS income. I hope it is clear. Next, you are receiving some dividend of 56 lakh rupees. You can show that as under IFRS, and you are distributing dividend of 40 lakh rupees 1 month prior to the due date of filing of return. So you can claim that 40 lakh rupees as a deduction under ATM. ATM you can claim as a deduction. Therefore, dividend received 56 lakh, dividend distributed 40 lakh. 40 lakhs you can claim as a deduction under ATM. The turnover of last to last year is 390 crore. Therefore, the tax rate will be 25%. On that, you apply surcharge and cess if applicable. Then you will compute the book profit. Book profit is directly given 520 lakhs, that is 5 crore 20 lakhs, 15% tax, 7% surcharge and 4% cess because the income is more than 1 crore, 7% surcharge will apply. Then you will compute tax as per 115 BAA. As per 115 BAA, when you will compute tax, everything is same, just add back the additional depreciation of this Surat unit. Additional depreciation will not be allowed, rest all will be same. I hope it is clear to all of you. Even ATM is allowed under 115 BAA. And then you check which is more beneficial, go for that. I hope it is clear. Next question we have done earlier, go and check. Same question. I am putting the reference here. Done earlier this question just now. We have done 5 incomes non-resident is earning. Remember or not? Debentures received, technical know-how given. Next question we have done earlier. Jan 26 trust, beautiful question. Beautiful question of trust, Jan 26 if you remember. Remember? Yes, next question is a good question. Question number B1. There is a foreign company which is located in Mauritius. Now they have a branch in India. They have opened a branch in India. Now they are saying that because we are opening a branch in India, we should be liable for tax rate of 30% which is applicable to domestic company. Officer said that no, we will apply 35% tax rate on you. We will not apply domestic company tax rate. We will apply 35% tax rate on you. We will not give you the domestic company tax rate. We will give you the foreign company tax rate. Now the assessee is saying that how can you apply foreign company tax rate on me? There is a DTAA between India and foreign country which says that the permanent establishment of a foreign company located in India cannot be charged less favorable as compared to the Indian companies. How can you charge us less favorable? You are charging Indian companies at 30%. You are charging us at 35%. How can you charge us less favorable? So to protect this, the income tax department has put an explanation in section 90. What is an explanation in section 90? That a charge of a tax at a rate higher than the domestic company is not considered as less favorable. Do you remember or not? So if we charge foreign company at 35%, an Indian company or domestic company at 30%, we cannot consider that. We do not say that as a less favorable charge. We say that as an equal favorable. We do not say that as a less favorable. I hope it is clear to all of you. I hope it is clear. It cannot be considered as less favorable. Next question is a very simple question, that the Income Tax Act provides for taxation of certain incomes earned by Mr. Xavier, non-resident. So a non-resident Xavier is there. He is earning some income from India. So the Income Tax Act is saying that you have to supposed to pay tax in India. But the DTAA, which applies to Mr. X, provides for taxation of such income in resident country. DTAA says that the tax will be charged in that country. Now Mr. Xavier liable to pay tax in India? Mr. Xavier is not liable to pay tax in India, provided he has to fulfill lot of things. See, in section 90 subsection 2, it is very clearly written that you have to apply the domestic tax law or you have to apply the DTAA tax law, whichever is more beneficial to the assessee. But for that, the assessee has to prove that he is a resident of country X. He has to prove that he is a resident of country X. For that, he has to take what? He has to obtain TRC from country X as per the prescribed format, which shall contain all the informations which are required by the income tax department, like name of assessee, like resident country of the assessee, details of the assessee, email address, phone number, lot of information has to be there in the TRC. If Mr. Xavier is ready to give that to us, we will pass on the DTAA benefits to him. Otherwise, we are not going to pass on the DTAA benefits to him without the documents of TRC. Next question, we have done. We have done. Check it please. We have done. Okay. Now this question we have not done. There is some mistake by ICI in this question. I'll tell you what. Mr. Arvind is running a business. His last year turnover is 202 lakhs. It is more than 1 crore. Now he's paying a monthly rent of 25,000 rupees for his office. So whether 194I will apply, 194I will not apply in this case. Why? Because the rent amount does not exceed 50,000 rupees per month. For 194I to apply, 194I. Only 194I will apply. IB is not applicable in this case. Why? Because Mr. Arvind is an individual. He is doing a business. His last year turnover is more than 1 crore rupees. Therefore, 194I is only applicable. IB, the question of IB does not arise only here. But ICI has given the answer by giving reference of IB, not I, which is wrong. IB is not applicable here. Yes, answer is correct of ICI. That whether TDS will be applicable, ICI said that IB will not apply because the rent is not exceeding 50,000. IB is not applicable only here. You have to give a reference of I only and say that I is not applicable. IB is not possible only. I is not applicable because the rent does not exceed 50,000 rupees. I hope it is clear to all of you. Next question. ABC Limited is operating in India and Ben Limited is in Japan. Ben owns 55% shares of ABC. Both of them are deemed to be associated because it is more than 26%. Similarly, out of the 7 directors, 4 are appointed by Ben. Therefore, because of this reason also both of them are deemed to be associated. Therefore, transfer pricing is applicable. Now, the AO while verification of international transaction of 300 lakhs, notice that assessee has not maintained requisite records. All records are not maintained by assessee. So which penalty will be imposed? 271AA. For not maintaining proper records as per 92D, 271AA will be applicable, 2% of the value of transaction. Second, assessee has also not obtained the accountant's report. If accountant's report is not obtained, that is form 3CB, then 271BA will be applicable on you. And 271BA penalty of 1 lakh rupees will be imposed on you. And along with that, 270A will also be applicable because if you are not obtaining accountant's report, it means you have not reported the transaction also. Not obtaining the report means not reporting the transaction, and for not reporting the transaction, there can be a penalty of 200% of tax payable on you, which can be called as misreporting of income. Misreporting penalty can also be imposed on you. I hope it is clear to all of you. Next question. RST INC, a US company having a POEM in India. It has advanced a loan of 170 crore to Shiva Limited. How much loan they have given to Shiva? 170 crore. What is the total book value of Shiva? The total book value of Shiva is 300 crore. Out of that 30 crores is repaid, it doesn't matter. What is repaid, it doesn't matter. Ignore that. So out of 300 crore book value of asset, 170 crore I am financing. Therefore, it is more than 51% of the total asset. Therefore, both of them are deemed to be associated. Market value is not relevant to determine associate enterprise. Even what is repaid during the financial year is not relevant to determine what is associate enterprise. I hope it is clear to all of you. Next question we have done earlier. Go and check. I have given the reference. All these questions we have done earlier, done earlier. Everything has been done till here now. Nothing has been left. You can go and check. Everything. After this, everything is done. Everything is done. Everything. Nothing is left. So here we complete the 8 MTPs. Here we complete The 9 RTPs and 9 past paper, total 26 papers are done. Once again, I would like to tell you all of you, I have recorded this twice for separately for all my dear student of English. It is not an easy task from my side. It is your duty to spread this to a maximum student as it is possible. Spread this to across the South India. Mainly I am talking to Guntur students, Andhra Pradesh Guntur students, where I have taken live batch this year. Spread it in all the hostels to the extent it is possible to give maximum benefits to maximum students across South India. I am putting extra efforts for you all. Please, please, please consider that much. Secondly, I would like to say, wherever you find anything important, please make sure that you put a timestamp below that in the comment box, so that when you refer for the second time, you make sure that you try to refer that directly by clicking on that particular timestamp. You don't have to waste your time. I hope it is clear to all of you. So that's it from my side. Very soon I will come up with some very important videos which might be relevant for you all. Till then, take care all of you. Bye. See you soon.